Back in August, when you were on Wall Street Week, I went back and checked. The federal funds rate was 250 basis points lower than it is right now. At the time, we talked about the extent to which low rates really created these companies that can't afford to pay the debt that they've incurred. Has the problem gotten better because interest rates are so much higher?
Well, I think maybe you should think of it in terms of medicine. Sometimes the medicine that you need to correct a condition really may taste awful and may make you feel ill for a short time before you get better. And this is the way it is with higher interest rates. Certainly we need higher interest rates. You can't maintain forever a period of ultra-low rates, and central banks around the world are addressing that issue. So over the longer term, it's going to correct the problem of too easy access to capital, too much debt, and so on. In the short term, though, higher rates are going to cause a lot of pain, and particularly for the kinds of companies that we've been talking about, these zombie firms whose earnings are not sufficient even to cover their debt service, let alone investment and operating costs. That's why we call them zombies. They're on borrowed time.
Well, and how long is that time? Do we have any sense of how long it takes? Because presumably they're going to have to renegotiate some of the debt as it comes due. It's going to be more expensive when they renegotiate, which just makes their situation worse.
Well, I think the difficulty is now we're heading into a period of slower economic growth while interest rates are continuing to move higher. So you have a tightening of what they call financial conditions. So access to capital is just getting a lot more difficult. So the next 6 months to a year are going to be very challenging in terms of making sure that companies can service their debt and that companies around the world, and especially small companies, which tend to have a harder time accessing capital in any case, can raise the funds they need to support jobs and growth and keep the economy humming along. So it's a challenging period over the next year or so.
So when companies do have to renegotiate their debt, do you expect it will be a problem of how much they have to pay on the interest on the new debt? Or is it possible some credit just won't be available at all? I mean, people are talking about a possible credit crunch, in part because of the problems we have with the banks here, in which case you couldn't get the credit no matter how much you're willing to pay for it.
I think there will be some instances like that. So the borrowing prospects of some firms have really tightened quite a bit. And the problem with higher interest rates is that there are ripple effects across all kinds of credit provisions. So, for example, you're also seeing tighter access to different forms of equity capital, to venture capital. So conditions in all kinds of ways to raise funds are not as good as they were even a year ago. Mostly, though, it's going to be a question of adapting to the higher cost of capital. So adjusting your plans. Maybe you'll have to scale back investment. Maybe you will have to not do that new hire that you wanted to make. So all of these things together create a rather challenging environment at a time when earnings prospects are already dimming in many parts of the world.
We've had interest rates relatively low around much of the world. How much of this is a U.S.-specific problem? How much of it do we see in other countries around the world?
No, you see it everywhere. And I think the particular challenge is for a number of emerging and developing economies, which are facing a perfect storm of difficult conditions. So a slowdown in major economies, a tightening in global capital markets, harder for them to access international markets to borrow, and also factors that still stem from the aftermath of the pandemic. So you have social issues, you have healthcare issues, you have climate vulnerabilities as well, which are becoming more and more apparent around the world, and particularly in many emerging and developing economies, which is a subject of discussion here in Washington, D.C. at the IMF World Bank spring meetings this week.
We'll talk about those meetings specifically because I'm mindful of the fact that it's not just private enterprises that could really have too much debt to service. We also have a number of countries, particularly middle and lower income countries. There's a lot of negotiation going on this week about what's to be done about that. Give us a sense about the sovereign debt situations. It's not a zombie country, but nonetheless, it's a problem not being able to service their debt.
The goal here is to bring all of these, which you might call stakeholders, together and find out a way to restructure sovereign debt when it has to happen. This process can be very drawn out, very long, and that makes it difficult for a borrowing country to get back on its feet again. So if we can speed up this process, and it's very helpful in this regard that China, who's a very large creditor for a number of low-income and developing economies, China is also present in these discussions at this new Global Sovereign Debt Roundtable. And it's very encouraging to see the constructive dialogue and suggestions for improvement in this process.
This is not a pleasant situation for the countries and the companies that own more debt than they can service. But how does it affect the rest of us, particularly in terms of growth? You mentioned earlier for some of the smaller companies in the United States, they have to change how they allocate their capital, how they use their funds if they're really choking on the debt.
No, I think that's a very good point, and often underappreciated, that in most economies around the world, it is the small and medium-sized enterprises, the SMEs, that are the engine of growth for the economy. And if those firms are having a harder time accessing capital, and the challenge is there's contagion, as it were, right? Because financial conditions and cost of borrowing aren't just getting worse for companies that have too much debt. They're getting worse across the board. So even for a healthy company, it may be a bit harder to get capital on as attractive terms as it was, a year or two ago.
Sonja, you study these things carefully. Is there also an opportunity cost to this? That is to say, if a lot of that capital is getting consumed in ways that are not very productive, there may be other entrepreneurs out there who'd like to get started, like to ramp up, and they can't because they can't get access to the capital.
I think that's right. I mean, think about the uses that firms have for capital, right? Some of it is for investment in new plant or machinery. Some of it is for hiring. But a chunk of it has to go for debt service. So when you think about it, it's a limited pie. And if you have to give a much bigger slice of it to service your debt, that's an opportunity cost. You can't use that capital for other sources. And it's also true, as you say, that if you're a small startup firm looking to enter the market and raise capital, and if established competitors, if other firms are already trying to tap the markets at the same time, then it's kind of a fight for capital, and you might even call that a credit crunch. And indeed, it's becoming increasingly clear that we may be already in a credit crunch.